Worried about inflation? Don't change a thing in your investment portfolio. This is pretty interesting. Let's read this article. This is right up my alley, as a matter of fact. So advisorperspectives.com. This is Nir Kassar. Who is old Nir? It's from Bloomberg. All right, so it doesn't say who old Nir is, but Nir is far from understanding who we are talking about. Get it? Near and far? Get it? All right, so Dateline 25 June 2020. Worried about inflation? Don't change a thing. All right, so investors tend to watch inflation closely, and good reason. The whole point of investing is to increase the value of money, so keeping pace with prices is crucial. But for a growing number of U.S. investors, a healthy regard for inflation has been replaced by an anxiety that, I cannot agree more with this. A healthy regard for inflation has been replaced by an anxiety that the U.S. is on the brink of surging prices. Admittedly, the current environment seems fertile for inflation. A lot of money is floating around. The Federal Reserve has injected roughly $3 trillion into the economy so far this year, added to the projected federal budget deficit of $3.7 trillion for 2020, according to the CBO, nearly triple the previous record of $1.4 in 2009. Meanwhile, economy virus is disrupting supply chains and hastening a breakdown of global trade. The cocktail of ample cash and shrinking inventories is a recipe for higher prices. Still, the impact on portfolios is far from clear. There are few historical examples to point because inflation has rarely been a threat to U.S. investors. See, did you hear that? Inflation has rarely been a threat to U.S. investors. A traditional 60-40 portfolio of stocks and bonds as represented by the S&P 500 and long-term government bonds has produced a real, or net of inflation, return of 5.8% a year since 1926, which includes reinvesting dividends. It also generated a positive return, real return net of inflation, of 89% of the time over 10-year rolling periods. In addition, almost all 10-year periods of negative real returns were clustered around a single decade, the notorious stagflation of the 1970s. I'm telling you, man, I could not agree more. If we just look at my, what we'll do here on my Wellington, the book I'm working, actually, let's look at this right here. Do I have this? I don't think I have the charts here yet. This is a 7%, I don't think I have it going down to 19, yeah, I don't. This is a 7% barbell. This is started 1931. 7% adjusted for inflation, barbell, Wellington. And look, it would have lasted until your 1953, adjusted for inflation from 1931 to 1953. That's at 7%. The drawback is we have this right here in let's see here, going to this is Wellington now, 1966, when we started getting the inflation from 66 to 72. But even 1966, your portfolio would have lasted at 5% distributions adjusted with inflation until 1985. That's 20 years. And if we go to 1973, this is when it gets really ugly here. 5%, well, I guess not. Actually, no, that's not true. Look at that, 5%. So you had to last, look at that, 5% adjusted for inflation. You still had over $50,000 from 1970 to 1997. I don't know why I ended in 1997. Is that 20 years? No. So that's interesting. All right. Well, I'm not sure why I ended there in 1997. It should have gone on to 2002. Interesting. But either way, we can fix that. But still, isn't that interesting? It's just this one time frame from basically the mid 60s until the early 80s. And if you could just have lasted everything else, look, I mean, I showed you a 7% barbell if you start in 1931 in the midst of the Great Depression. Here's a 6% barbell, 1931. I mean, if you can last 7%, you can last 6% inherently, right? Start in 1930 got bad because 1930 you had big negative returns in 1930, starting down 21% in 1930. 26.5% in 1931, and then about 2% in 1932. But all right, let's keep reading. By the end of 1969, the inflation rate had swelled to 6.2, more than 3 times its long-term average since 1871, according to Schiller. So let's just he's saying 1969 inflation was at 6.2 by the end. I'm not sure All right, I'm just curious. Investing during inflation, 1969. Let's bear with me just a second. That's a negative. That's the. I guess we're looking at S&P 500. Well, right here, inflation. So here we go. 1969. Yeah, right at the. All right, so we're using the. I guess the midterm of the year. I'm picking up a Schiller stuff there. So 1969, 5.46. This guy's looking at the end of the year at 6.9 because it starts going up each and every. I mean, literally by then it's like month by month by month. All right, let's see. It would eventually climb to 15% in 1980 before finally falling to a more normal level in 1983. So how did the Trusty 60-40 portfolio hold up against stagflation? Surprisingly well. It produced a nominal or gross of inflation return of 7.8% a year and had a real return of 0.1. In short, it kept up with inflation. Yeah, it kept up with inflation, but not for withdrawals. That's the issue here. If you're taking money out during that time, you're doomed. That's inflation is the killer to retirement. No other way around that. You made a little bit of money from that 12-year time frame, 0.1% a year real, but after taxes you didn't, and if you're taking money out, you're screwed. But the more interesting and instructive bits are in the details. As it turns out, the parts didn't contribute equally to the whole. The stocks held up well, producing real return of 0.3 during that period. While it's never safe to generalize based on a single anecdote, it makes intuitive sense that stocks might be a good inflation hedge. He talks about Jerry Siegel. He says stocks are a claim on real assets, and real assets will rise in value with an increase in the general level of prices. Notably, stocks did just that while battling two headwinds, inflation, and namely declining earnings and contracting valuations. Real earnings declined by 1.3% a year from 1970 to 1982, while the PE ratio shrank by 2.7 a year based on 12-month, and yet investment stocks held its value. Bonds, on the other hand, weren't so lucky. They returned a negative 0.8 a year after inflation during the period. That isn't surprising either. Higher inflation should result in higher interest rates, and both because lenders tend to want to be repaid in real dollars, not discounted dollars because of inflation, and because central bankers are likely to raise interest rates to tame inflation, which is exactly what Volcker and Reagan did. In fact, the correlation between inflation and 10-year yields has been generally weak since 1871, 0.26%. It strengthened during the time frame from 1970 to 1982, doubled as interest rates followed inflation. That's interesting. Man, a 0.26% correlation between yields and 10-year treasury, between inflation. I did not know that. When interest rates go up, bond prices go down, but not all bonds and not all equally. In general, bonds with longer maturities are more valuable to rising interest rates than those with shorter maturities. I've said this 1,000 times a Sunday. Longer-term bonds and higher and lower interest rates are more volatile than shorter-term bonds with higher interest rates. While investment in the long-term bonds eroded from 1970 to 1982, 5-year treasuries returned 0.8% after inflation, and 1-month treasuries perfectly tracked the rate. The takeaway from all this is that investors who are worried about inflation needn't overhaul their portfolio. A simple mix of stocks and short to mid-term bonds is probably better than investments wildly peddled as inflation protection, such as gold, crypto, real estate, or even TIPS, inflation-protected securities. I don't know about that. I think real estate is probably a decent hedge. You're not in an inflationary time, you're just trying to break even. You're not trying to make money. And as we can see, stocks didn't make money. They made 0.3%. Bonds made, long-term bonds, 0.1, I think. Or no, that's the portfolio. Long-term bonds lost a little bit. Stocks made a little bit. Real estate probably did okay relative to inflation. Yeah, during inflation, it's trying to keep even, man. That's all you're trying to do. So I disagree with real estate. In gold, we don't have enough evidence. We don't have any evidence on crypto. And TIPS, I think TIPS will probably keep you up with inflation. Those tempted to hoard gold bars until the threat passes should think twice. As probable as inflation may seem, it's impossible to know when it'll take hold, if ever. Inflation bugs have been carping for years at the fiscal and monetary stimulus unleashed after the 2008 crisis would stoke inflation. No, they've been carping for years before that. They've been carping for years under Louis Rukeyser's thing this week with Louis Rukeyser. I showed you the guy from Goldman Sachs who said inflation is coming because of the debt that the government had, the balanced budget deficits that they had. They've been talking about that for freaking decades, man. And yet it's not here. It's not coming. I'm telling you right now. Let's see. Inflation bugs, but it hasn't happened despite the Fed's repeated attempt to lift prices. Japan's central bankers have been at it for nearly 3 decades and mostly without success. It's worth noting that the bond market isn't worried about inflation either. Yeah, I can agree more. The break-even rate of the Treasury is 1.4%. That's the difference between the yield on nominal inflation-protected 10-year Treasuries. While it has risen since the combi virus panic receded in late March, it has also trended downward since 2018 and remains stubbornly below the Fed's target rate of 2%. Investors are free to worry about inflation, of course, but most are likely to find that the best defense is already nested in their portfolio. I completely agree. Gold bugs, you got no evidence to validate because there's not enough time. We don't have enough sample size. Crypto, we have no sample size. Tips, I think, will give you break even. I think it's the whole point of tips. I think real estate, if you're worried about inflation, is a good bet for sure. You're not going to make much money in inflation. You're trying to break even. Hope this helps. I'll put a link in the show notes. We'll see you.